Travis, we've talked about private markets, their growth, and how we can access them through your portfolio, haven't we?
Yeah.
The next step is educating yourself on the trade-offs between the various structures we can use to access these private markets. Okay, and so the options can be confusing, and there's no universal best answer, is there?
Unfortunately, it's no.
Instead, the decision is based off of trade-offs between liquidity, simplicity, the availability, and then the last one's performance.
Right. Yeah, and that's a critical point here, Steve. I mean, private market investing is going to be new to a lot of people that haven't, dived into that area. So education here is just going to be vital. Let's start with what we call evergreen structures or evergreen funds.
Yeah.
Some people call them interval funds. It just depends. But they tend to be the most liquid and the most straightforward to understand. I mean, evergreen funds are generally perpetual, means they don't have a targeted end date.
Right.
They continually reinvest in private opportunities, either via other funds or direct deals or even co-investments. But they do have periodic fund redemptions, or they call them repurchases, where they say, hey, we're going to offer to repurchase your shares. And those are the primary drivers of liquidity in evergreen funds. However, and there's always a however in private markets, right? You can run into gates, or you can think of those as limits, right? On liquidity. And gates prevent forced asset sales at unfavorable prices, in protecting current and future shareholders while providing liquidity to those who want it. For example, the fund will say, hey, we're gonna offer 5% of the fund's AUM in liquidity this quarter for people who want it.
Yeah.
And if 1% redemption comes in, everyone gets the redemptions they want. If 20% redemption comes in, the fund will say,
Wait a minute.
hey, we're only giving 5, so they'll prorate your distribution request, but that helps protect the people who want to stay in the fund, who want those assets to work for them and not be sold maybe at distressed prices, like we probably saw with real estate, the last year, office REITs and things like that, right? So evergreen fund investors, as we talked about the trade-offs, they have more liquidity and flexibility in choosing their entrance and exit into an investment than other structures, right?
So true. And now let's discuss what's called drawdown funds.
Yeah.
Which are more complicated investment vehicles.
Yeah.
Drawdown funds are generally illiquid. Once capital is called, the funds are locked up until a distribution occurs, either through the fund's manager's discretion or through yields and investment exits.
Sure.
Okay? And so typically these strategies involve a holding period also of 5 to 10 years. Drawdown funds generally have higher minimum investment requirements, which make them less accessible to the smaller investor.
Right.
However, the range of the available funds is broader for those who meet the minimum standards, offering more tailored investment options. For more tailored investment options for specific client needs.
Right.
Okay.
Yeah.
And so the other critical point is that liquidity you mentioned in evergreen funds comes from holding cash or public securities, right, which can draw down the performance of the fund. So over the life of the investment, drawdown funds tend to generate favorable returns, don't they?
Yeah, I mean, because the capital's locked up, and you've been doing this for well over 20 years, and you've seen
real good ones,
some really good ones, right? But
Yes.
then you've also seen ones that haven't worked out as well with the capital being
and those
locked
are
up.
tough for clients to choke down.
Yeah, because
But it
there's no
happens.
liquidity in them,
Correct.
right? Until, like you said, the manager wants to exit or the deal winds down. So it's a different type. This is a different experience, a different type of risk. Because, like you said, also if you're tailoring it, you're talking about maybe specific projects, specific deals versus
Yeah.
the evergreen funds that are investing in a broad array, which also helps explain why the returns can be better in those drawdown funds versus the
Correct, because you have there's more. It's more specific, or there's more concentration.
more
really.
concentration.
It's
Yeah,
more
right.
concentration.
Yeah. So, bottom line here, Steve, when choosing a fund structure for private investments, there's no perfect one, as you pointed out. It's just about managing trade-offs to find the best answer for you specifically. So educate yourself to help you understand what's going to work best for your situation. If you're curious about the different types of structures, which hopefully people are,
Yeah.
that private market investments come packaged in, and you want to understand how they might apply to your situation, call us, right? I mean, we have advisors in Omaha, Grand Island, Ogallala, even an office in Scottsbluff, and we're more than willing to sit down with you, get on the phone with you, talk through this, help you understand what the different structures are, how they might apply to your situation, and how we use them for client portfolios.
Absolutely, because everybody is different. And so one may be good for a drawdown fund for one client, and then the evergreen may be better for another.
Absolutely.
So,
Absolutely. Yeah.
Travis has been great. I look forward to it next week.
Look forward to it as well,
You
Steve.
got choked up?
You got choked up.